How is everyone? It's Saturday morning, sat in the office overlooking the Thames here in London. It was an interesting week last week, to say the least. We had a couple of losing trades last week, which no one ever likes, but it's always a good check to reality, brings you back into line, gets rid of the overconfidence, and makes you realize that trading, although we can have a lot of good profits out of the industry and we can make some good money, we have to keep in check and we have to stick to our plan and never let the markets take control of us. We must always be in control. So it was nice to have a couple of losses, got the overconfidence out and back into sync. Okay, so last week we did see a little bit of a sell-off still in Asia throughout the Hang Seng and the Shanghai Composite. But what we did notice is that the markets approached some key levels, and especially with the Japanese yen, which we're going to focus on throughout this presentation. So we're going to start with the euro dollar. Now you can see the screen grab that I've taken here was taken early Friday afternoon. This is because I was getting my analysis done. There was no trading. I was waiting for the dust to settle after everything that was announced last week. So euro dollar. Now I've put here we've got a 350 pip range. Well, that's if we take from these highs over here down to these lows. You're talking pretty much a 250 pip range within here. So down to your early 108s, 107.40s, up to your 1.01s. Okay, so we could look to trade the range, or our bias, our fundamental bias and our technical bias is to the downside. However, before we're going to trade and hold for the longer term short, we want to see a break and close below this low, indicated by this directional arrow. Okay, so I want to see a break and close below here. We're going to look to use this demand or supply zone, and the reason I say demand or supply, whatever price is above, it's a demand zone. Once price comes below, it'll be a supply zone. Simple economics. Okay, so we'll look to use this trap range unless we get a close below here, and then we're just going to look to sell off for longer term targets of 104s, and then potentially may see parity towards the end of the year or a little bit longer. Now, in March is going to be a key month for the euro dollar. Why? Well, we've got the next big ECB meeting in March, which Mario Draghi said they'll be making more commitments there. We've also got the Fed. Will the Fed do another rate hike? Won't they? Who knows? What we can say is at Phoenix Blue, we will always trade the charts with a fundamental bias. Our bias currently is dollar strength. Why are we dollar strength? We're dollar strength because they're the only economy that are talking up rate hikes. So we've got monetary policy divergences. We've got the euro reduced rates, potentially reducing and more QE come March. Canadian dollar potentially reducing next time. We've got Japanese yen, Kiwi, Aussie dollar. They're all looking at reducing potential interest rates. Japanese yen not so much, but Kiwi and Aussie dollar for sure. Okay, so euro dollar, our bias is to the downside. You can see key areas where we'll be looking at shorting. We did take a sell in here at 109.70. We hit our first targets in the middle of the range, only for it to come back up and take us out at break even on our second position the day before Mario's announcement, which is a shame because we'd have gone on and hit second targets and a very, very handsome reward. Next chart we'll be looking at is GBP USD. Now what we can see here is going back to 2013 lows through here, this is where we had commitment at traders extremes. So the commercials were long before we had our extreme long, I should say. So that's the difference between their long contracts and their short contracts, creating a net position. Here, this is where we then started a bull run for cable over a year-long period. Okay. At the same point, at the top here, we did get commercials with extreme short positioning. Okay, so this is a significant part of our trading style and our teaching style. Something we look at. Anyone can trade the trend. Anyone can trade the trend. Trading trend is simple. The question is, where is the trend likely to come to an end? And this is something we'll be focusing on with GBP. Okay, we think there's further downside, so we're looking to sell on any retracements, and we'll come back to the commitment of traders analysis on GBP in a little while. So how can we look to take advantage of this particular market? Well, first thing that stands out to us is the market 2015 came into lows here. It was an 18-month extreme. Okay, this means the commercials were their most bullish looking back over an 18-month look back. We did get an interesting bullish move from there. It did come up to the top, and then we've had a continued sell-off. Okay, so now we're expecting further sell-off. But if we go back here, we can see we've got the anchor, more resistance, come support, come back down to test support. Now, on the commitment of traders side, we've got a 6-month bullish extreme, so I'm expecting to see a kickback. I'm expecting to see that retracement. Now, the short-term traders, yeah, if you want to be looking for longs, by all means, look to longs up into around the 1.4650s, and then further longs up to around 1.4820 to 149. Okay, this will be our second area where we're expecting to see oversupply. So we'd like to see an initial push up into here, where we get 2015 lows, potentially top of the rising wedge, or up to 1.4820 to 1.49. Again, major supply zone. Why? It was a demand zone over here, and we're looking for it to turn into a supply zone over here. On the flip side, it's also going to be at the top of the rising wedge as well. So we're looking for further downside. So we're looking to sell cable on any further retracements. So be patient. If you are a short-term trader, then there's definitely going to be opportunity for you to take advantage of the short-term momentum, which we believe will be to the upside. Okay, next chart we're looking at is New Zealand US dollar. Okay, so we've been bearish Kiwi for some period now. Our initial trade was up here, which you can see highlighted. We took this at 68.60. We're currently still in this trade. Okay, one of our losers actually did come in here. Why? Well, this trend is down. We have a double top. Okay, we can see a retest of structure. It's also a fib level from our last major move down. Weekly candle. If you just wanted to sell the weekly candle, it's a very nice bearish shooting star at structure. Okay, first targets from any double top, especially with trend, we should be looking to at least target the neckline. Well, it doesn't take a math genius to work out. Looking at this one shooting star here, the reward down to this neckline is significant. We took it with Phoenix Blue methodology very aggressively, 68.60 with stops at 69. Okay, we're still in this position now. You can see when I screenshotted this on Friday, price was at 65.03. That's a 360 pip profit for a 40 pip stop. Okay, 40 pip stop, 360 pip current profit. Okay, that's a fantastic return. A fantastic return of anyone's capital. If you're a long-term investor, you've nearly done your year's investing in a few short weeks. Okay, so we entered that trade live on the 29th of December. 29th of December, and here we are, sat third week in January, and we've already got double digits returns. Okay, who would like to be sitting at those kind of returns already in January? If you're trading with a substantial account, and you're a long-term investor, you've done your year's investing, and we're on the 22nd of January. However, that's not my style. I want to get as big a returns as possible, but only from fundamentally and technically sound trades. Always trade with a bias, always trade with a reason, and make sure that direction and trade management and risk management are always spot on. Okay, trade with a plan, stick to the plan, and you will come out profitable. That's what we teach at Phoenix Blue, and that's how we help educate people who not necessarily aren't succeeding in trading, but how to improve. We focus on consistency, applying the same methodology, applying the same plan every day. Okay, consistency is key. Repetition is the mother skill. Now we can see we've got profit locked in already down here. Looking at a return coming up just what 4.5 to 1 already in there. Now we did have a losing trade, as I did say. We looked to add into our position at the neckline, so we sold at 65.13 and we put a stop at 65.53. Unfortunately, the market decided to push that a little bit higher. It stopped us out at 65.53, pushing up to 65.59 yesterday before turning. So we were a little bit unfortunate there, but hey, it's part and parcel of trading. We're going to take some losses. You have to take them on the chin, and providing your risk management is always spot on, you should never be upset with a trade because you're going to never lose more than you're prepared to lose. We still believe that there's further downside to this. I will be looking to add in again. You see, I've got another alert sat here. Okay, I will be looking to run my initial trade from the top down to 63.20. As soon as we get close below these lows here, I'll be looking to use this demand zone to potentially run further down to 0.6. But once it gets down here, I will be doing more assessment on the commitment of traders, which we'll look at a little bit later. Okay, so that's Kiwi dollar. Okay, does that make sense, guys? Any questions? If you're not following or that you've got certain questions about the slides or the video today, what I suggest is you drop me an email at info@phoenixblue.co.uk. We update Instagram and Facebook most days with certain charts we're looking at, potential trade positions. Everything we do will always be ahead of time. We're not hindsight traders, okay? So guys, just remember and follow us. Always get a hold of us at info@phoenixblue.co.uk. Our next chart is going to be the dollar Swiss. And this one has been building a beautiful position. It's been fantastic, okay? Now you can see we're looking at two different trend lines here, one longer term, one shorter term. Okay, so this one's from August 15 lows. We can see we've had 1, 2, 3 very clear touches and coming over here. But since then, the market decided to be a little bit more aggressive. We can see the market being cyclical, creating higher highs, higher lows. And there's this trend line coming in here that's had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 tests now of the wicks on this particular trend line. Very, very nice. Okay, and it was the 10th one that we actually entered our trade. Okay, so we entered long at 99.65. Okay, so we were in at 99.65. Now, if we look left where we can see our green dotted line, this is our entry. You'll notice that there's some clear structure. Okay, we can see this. The market tested this very, very nicely. So here, test, 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 broke out, came back to test again, moved on, and do you know what? We went long here, again with a 40-point stop. We hit initial targets at 10070, okay? So 10070. That was 105 points first target, so just over a 2.5 to 1. So for every £1,000 risk, you'd have got £2,500 back. Now, we've got our extended targets at 1.03, okay, just at these closing prices up here. Now, Friday, this is before the close, way before the close. We screenshotted this probably about 2 o'clock Friday afternoon. So price tested these highs. Now we're looking for a close above these highs. So as I've put here, we're looking to build a bigger position. We're still focusing on dollar strength. Okay, so I'm looking for a dollar close, or a dollar Swiss close above this black zone here. It also created a new high, so this is perfect for me. Okay, now what we're looking at is I want to build a bigger position. Should the market come back into here, I'll be looking to add into my position to run back to the upside. If it doesn't pull back into here, what I will be doing is just holding this initial position and hopefully taking it up here, along the way managing our stop according to our rules. Now again, I will mention this again, we do have set specific rules, but I also work with you as individuals. Now I work with you as individuals because trading, we all see the charts in a slightly different way. It's down to perception. Now, and a slight bit of discretion. So when we talk about perception, it's a bit like we all have the opportunity to go to the high street and choose our clothes, choose our shoes, but we all wear different things. Why? That's because we perceive things slightly differently. So I work with you as traders in order for you to understand the charts in your own way. So you'll do a lot of testing. You'll collect a lot of data. You'll work out which method suits you best and how to manage it according to your lifestyle, because this is a lifestyle industry, okay? I got into trading because I wanted to travel the world. I wanted to make lots of money, and I wanted to do it in a way that suited me, which means I don't have to wait for customers. It means that if I want to go on holiday, I can go on holiday. If I want to go on a boat, I can go on a boat. If I don't want to trade for a couple of weeks, I don't have to trade. Okay? Remember, this is our business and we control our position in the market. We can never let the market control us. If we don't want to trade, we do not trade. If we don't have a bias, we will not trade. If we don't have a set of rules, guess what? I won't let you trade. So we're looking to build this position up to 103s. Okay, we're half out, stops already locked profit in. We'll be moving stops up again a little bit higher come the close, come Monday I should say. Now that we've had a close above this zone, we'll be moving stops up to around 1.0070. So we'll be locking in 105 pips of profit. So that will guarantee us a 2.5 to 1 return on our initial investment, because we've already taken half out at 1.0070. Okay, hope this is making sense. Okay, next chart. It has been a fantastic start to the year, guys, and this isn't all about bragging and showing you how much money we're making, because I have told you we have lost some trades this week. Okay, now where were we? Aussie USD. Okay, our bias and our long-term view on Aussie USD is short. We're selling Aussie dollar on any retracement. Why? Well, we have to think about what makes the Australian economy drive. Okay, the biggest influence for the Australian economy is China. What's happening to China? What's happening to commodity prices? Okay, China import most of, if not 90% of their raw earth minerals and gold from Australia. China is in free fall at the minute, so they're devaluing their currency. They're devaluing their currency to try and increase exports. Now, if we saw the PMI numbers for, which is the manufacturing numbers for China, they've been in contraction as an economy, contraction, not expansion, for the last 11 months out of 12. Now, what that means is the PMI numbers have been below 50. Being below 50 means contraction. So as an economy, they're slowing down, therefore they're trying to devalue the currency to stimulate the economy. So, on the back of that, the flip side is it's going to have a negative impact on the Australian economy. Therefore, we see further downside fundamentally. So technically, we then just look to line up and take the trades. So initially, our first trade came in here. I think it was the 30th of December, if I remember rightly. In fact, the 4th of January. 4th of January. Why? We've got support. We can see clear tests of support. Now this resistance, I should say, and this goes further back. Okay, so we've got resistance, resistance, resistance. A false break to the upside. Okay, it came down, tested our support, which we can see clear test. Then it's come back up. Now, what we see is a lovely rejection candle. Now this was a Friday candle. As soon as the market opened Sunday night, at Phoenix Blue, we just sold. We sold, it had about a 55, 60 point stop initially. So 72, let me just have a quick look at my account and tell you exactly what our entry price was. It was about 72.85, if I remember rightly. Trade 72.85.9 was our entry price. Okay, and we entered that on the 4th of January, basically at midnight. Okay. So 72.85, stops went above the high. Initial targets were down at the bottom of the wedge. Now through here it says second entry. Now this second entry, this is something that I did. It was about 2 o'clock in the morning, 2, 3 o'clock in the morning. I was listening to the news. I was watching. It was a bit of luck, to be in all honesty. I was watching the news, watching headlines come out, and it was the Chinese Shanghai composite. The circuit breakers triggered, it dropped over 7%, the market shut down. So the first thing I did was start looking on the charts, at live charts, looking for any price action signals to sell off the Aussie dollar. So we got in again, Aussie dollar 71.54. Okay, so 71.54 was our second entry. It moved down beautifully, broke 2015 lows, looks fantastic on a weekly and a monthly chart. It is due a pullback, and we're short again, actually. So we took a trade here at 70.43 yesterday. We got triggered at 70.43. As I can highlight here, stops at 70.83. The market's moved 50 pips in our direction, so stops are at break even. Now we'll be looking to target these lows initially with our first target. Second target, we're going to look anywhere in the region of sort of 65s, longer term targets, maybe down to 6,300, 6,400s as a longer term trader. But you have to think about what type of trader you are. Okay, do you want to sit in positions for long periods of time, or do you want to be in and out? If you want to be in and out, then we'll be looking at exiting somewhere in and around these lows, looking then for the market to break, create new lows, and then use this structure here to get short again. Okay, so that's Aussie USD. Again, fundamental and technicals lined up. Okay, dollar yen, fantastic chart. Now, dollar yen, or let's talk about the yen, not just dollar yen. So the yen is a safe haven. This is where we see money flow. Now, what happens is when we see uncertainty in the markets, you'll see that the markets will move from equities, okay, or global indexes, and they'll move into something called a safe haven. Why? Because they don't want to leave their hard-earned money into an asset that is likely to depreciate in value and not give the yield that they longer desire as an investor. So what investors technically do is they move from something called risk on to risk off. So uncertainty in the market, they move to a safe haven. So safe havens will be yen, will be gold, okay, US dollars. This is what usually happens. So now where we're at, we can see that we've got major support, okay, this 116 area. Okay, this 116 area is a very, very key level. It's key level because it correlates beautifully with the S&P 500 and the Dow Jones. And I did a post on this on Instagram. Our Instagram is Phoenix Blue Trading, and you'll be able to see the correlation between the S&P and the dollar yen. If this level breaks, you'll probably see that the Dow will break 15,000, 15,200, and you'll probably see the S&P break its key levels. I think it's about 1880, something like that. Forgive me if I've got the numbers wrong on the S&P. So what we did, we actually took a very aggressive entry 2 days ago, just through here. Okay, we actually went long at 1610. Now, the reason for this trade, it is a very risky trade. I didn't ask or tell my clients to trade it. I told them what I was doing. It was a reduced risk trade, but the reason behind the trade was fundamentally and technically sound. Okay, fundamentals. The global indexes had sold off significantly, massively in fact. Now, if this zone or this major support area had broken, then what we would probably have seen is a worldwide sell-off, collapse. So what I was looking for was, I call them the plunge protection team. So whoever that may be, whether it's the institutions, whether it's banks, come in and try and prop up the stock market. So I was looking for a reduced risk trade, came in at 116.10, stops at 115.85, so very small stop loss, 25 point stop loss, and I actually exited 75% of my position at 116.92. So we got 82 pips out of that trade off a 25 point stop, and we left 25% in. The market now has triggered my sell at 1880. We did take a trade at 1830. Okay, we did bank some of the position, and we moved our stops to break even at 1830. That got triggered. second position got stopped out. Then late last night, Friday evening, our 1880 order got filled. It's basically at break even, small loss, small profit. So we're looking at trading this range back down to the 116s. Okay, so we're trading the technicals and the fundamentals. Okay, I do believe we're going to see a sell-off in the markets globally. I don't think all the news out of China is fully come to fruition or it's come to light yet. The news about achieving GDP of 6.8%, well, how true is it? Is it massaged? I can't say, but what I can tell you is, and this is fact, that the numbers, the manufacturing numbers coming out of China have been below 50 the last 10 months in a row, and January was below. So we've had 11 out of 12 months. The last time they were above 50 was February 2015. So I think we've got more bad news to come out of China. So I'm looking for ways to get into the global indexes short. Okay, next chart we're looking at is dollar CAD. Okay, we've got a fib overlap running through the 1.4 level. Okay, you can see that by the black box. We've got a 50% and a 61.8% retracement. So it looks very nice as a good area to be potentially buying dollar CAD. Now we're buying dollar CAD on the backside of oil prices. So Canadians' biggest export or number one export is oil. So we have to think about how can we take advantage of this particular market. Well, oil has been in free fall. It is due a correction, and this is what we're seeing right now. But in all honesty, I'm still looking at shorting oil. Therefore, I'm looking at buying dollar CAD. I'm looking at long dollar CAD. One trade or the other, I look at the correlations. I will take advantage of one. Here, 1.4 looks a nice level to be getting long. So I'll be looking at extended targets in the region of 1.5. Initial targets, my mistake. In and around 1.46 will be initial targets. Okay, so there's a nice 600 pip move. Now, depending how you want to get in on that trade will come down to your style of trading. Are you going to drop down the time frames? Are you going to trade price action? Are you going to do limit orders? Okay, have your trade planned out before you actually trade it. Know what you're doing so there's no impulsive, rash decisions. Okay, this is something that we always make sure. It will take you time. You're not going to become that kind of trader initially, but you will become that trader with time, practice, okay, and the right guidance. Okay. So next chart, we're moving on to the S&P now. So we'll come across to a couple of commodities after this. So the S&P, this is the trend line that I was talking about and the level. So we can see we've had multiple touches here, and I'm using the extreme of these wicks. Why? Because I want to see a close below here. If we see a close below here, then boom, we'll probably see a very big correction in the market. I don't know, maybe 20-30%. I'm guessing, taking it down to about 1,500. Okay. Now this is the day that we actually bought the dollar yen. This is a weekly chart. So this is the day that we bought the dollar yen. It was testing here on the S&P. It was testing the 116 level on dollar yen, and we got the reaction that I was anticipating. Now you can see that I've put in 3 different colored arrows or directional arrows. So we've got a black, a red, and a blue. They actually don't mean anything, the different colors. It's just so you can see that I've got 3 different plans of attack. Okay, things that I'm looking for. Now, each green box highlights a potential supply zone where I'll look for the market to potentially sell off. Okay, so preferred area I'm going to be looking at is that 50% retracement up in and around 1960, I think it is. Okay, and then the next zone I'm going to be looking at is up around 2010. Okay, so what we have there is we've got structure lining up with fibs, and fundamentally I'm looking for the sell-off. Okay, so we might see one last rally in the S&P and Dow. It's a little bit predictive on my side, but this is what I'm looking for. If I'm proven wrong, I'm proven wrong, and I'll take a few losses. But at the end of the day, we have to have a direction. If not, then we're just guessing. So This is our technicals, this is our viewpoint, this is our stance. Okay, and I'm giving you this information prior to the markets doing this. So this is all educational. This is how I and our team at Phoenix Blue are going to trade. Okay, so you'll see it, whether I get it right, whether I get it wrong. Okay, but more often than not, we generally get the direction right. Now, the next difficult part is the entry and the stop, because you can get the direction right, then you've got to think about the timing. So the timing is one thing, entries and stop is another, and then it's the management. Most people will get everything right, but unfortunately their management lets them down, their timing lets them down, something will let them down. The markets are very, very difficult to trade, and difficult to trade consistently. But what you'll see from our videos, from our posts on Instagram and Facebook is that January, we've had a very, very good January. I mean, seriously good January. Will February be as good? Will the rest of the year be as good? I hope so. But if not, all I want to be is consistent. I want to use the same methodology, the same fundamental views, the same directional bias, and the same technical skills with the same management systems. This way you can evaluate and review how you are performing. If you are changing something week in, week out, you will never be able to review what you are doing because you're not being consistent. Okay? Right, next chart, guys. We're going to look at gold. Okay, so this lines up with exactly what we've been talking about. Apart from, we've been talking about dollar strength. We've been talking about potential sell-off in the equity markets. Okay, potential yen strength as a safe haven. So therefore, if the market's going to sell off, if we're going to have dollar strength and yen strength, in theory we should have gold strength as well. Okay, it's another safe haven. So our initial entries were long at 1075. Okay, we got long 1075 on this black candle here. So this is a weekly candle. So we look at the market. It's not weekly, sorry. Yes, it is weekly chart. My bad. Okay, we looked at this trend line through here. Okay, this big bullish candle here, this big bullish week, this one closed above the trend line. We then looked at the market to retrace back. Our short-term trend line through here, the market came back to test here, but also if we look left, we can see this structure through here. Look at these weekly candles, the closing prices and tips and wicks, etc. Nice test. Market came back down, it tested, and it triggered us in. Our initial stops were at 1055. Our stops are now at break even. Now, some of my traders have already exited half of their position at 1105 last week inside this box. My target is actually 1120. Maybe you could say I'm being a little bit greedy here, but I am locking in profit all the way up. So 1120 is my first target. I'm looking for a close above these highs here. We get a close above, and then I'll look to use this supply and demand zone to get long again. Ultimately, I'm looking for a 1225 target, but top of this falling wedge, I'll be looking at exiting some through here around 1180 as well. So all adding up for the safe haven increasing price of gold. Okay, now this is oil chart, so you'll probably see this is very inverse correlation to dollar CAD. Okay, we're getting a huge sell-off in oil. So the sell-off in oil is largely due to OPEC increasing their oil production. They've actually lifted the ceiling. There is no longer a ceiling on production. Now, Iran have also come back into the market. All their trade embargoes have been lifted. They're producing 500,000 barrels a day, and they're looking to increase that up to about 1 million barrels a day. So what this means is the market is getting flooded with oil stocks, and there isn't the demand to actually use it. Therefore, simple economics, oversupply, not enough demand, only one way for price to go, and that's down. So my advice for my traders here at Phoenix Blue is we're just looking at selling any retracements. We've got two sort of key areas where we're looking at selling from. One is in and around the $34.50 barrel, and the other one is up around 38. You'll see they come off two fib areas and trend lines, and we're looking to target sort of $26 a barrel minimum. How much further will it go? Will it go to 20? Who knows? But trade the technicals, trade the fundamentals. When all directions line up together, we can then start going for extended targets. If you're just trading technicals, then be aware and make sure you are trading to the next zones. Get your money out quickly. Okay, so now we're going to move on to a lot of the yen pairs. Now, I'm showing you the yen pairs because this is the correlation between risk on, risk off. And you'll see that yen pairs are hitting major zones. So this is CAD yen. Now, CAD is weak. It's going through a little period of strength now, and we're looking at CAD to maybe strengthen next week before its next sell-off, because we're looking to go long dollar CAD, which means buy US dollars and sell Canadian dollars from around 1.4. We're also looking at selling dollar yen, or I should say we are now selling dollar yen from 1880. So what we're looking at here is the Canadian yen chart, and we're looking for a little bit of a rally, okay, up to this trend line here before a further sell-off. Now this is the weekly chart of the Canadian yen or CAD yen, and we'll see we've got multiple touches, 1, 2, 3, going back to August '08. Then you'll see these sort of tram lines that we've got coming down here, where we've got multiple interaction through here, where the big sell-off actually happened to intersect both of those trend lines. Now, if we did a parallel tram line here, you'll see that there's a lot of interaction coming through that upper one as well. So we're looking for price to rally up and around maybe the 84, 85 barrier, top of that channel, looking to sell off, and we'd look to see price break this support trend line here, and if possible, what we'll do is we'll look for a pullback to the trend line, and we'll look to sell again. We'll look to build that position. The next chart we're going to look at is pound yen. Okay, pound yen. What were we looking for on GBP USD? Well, GBP, we were looking for a slight rally and then a sell-off. Do you remember? We highlighted a couple of charts earlier. You can go back in the video and you'll see how GBP USD, cable, and pound yen are potentially lining up. So we're looking for a rally in pound, okay, a little bit of pound strength, and then looking for this to sell off. Now, this will mean selling pound and buying Japanese yen. So if we are going to get a sell-off in the global markets, we'll probably find that that means that money will move from the equities into Japanese yen, therefore Japanese yen getting stronger. A sell-off in pound, we sell strength and buy weakness, or I should say we buy strength and sell weakness in this instance. We'll be looking at an exponential move on pound yen. Okay, and the next chart we're looking at is Kiwi yen. Okay, we can see huge demand level. Now, let's see what happens. See if this level is going to break down. Like I said previously, we're shorting Aussie, we're shorting Kiwi, and potentially we're looking at buying yen on more charts than one. We're looking for that safe haven to continue strength, but we'll need to see a breakdown in the global markets, and we'll see. This is our plan of action. We want to see a break and close below this low here, and then we'll look for a retest in and around this green zone here. So very simple. And then our next chart is Euro Yen. This is before we move on to the commitment of traders. Okay, so Euro Yen. Again, very simple. We can see a nice demand zone. The reaction we're looking for will be a breakthrough and close below. Why? We're looking at the Euro 1.08 to sell off. We want to close below that, and then we can use that floor as our ceiling. Now, if we do get a bounce from 108 on Euro Dollar, we might get a bounce up here to the top of this channel, a bit like we're looking for on GBP JPY. Okay, we're looking maybe for that short-term momentum on either Euro or Pound, because they're both sat at particular support levels, before we can see continued sell-off. Okay, so that's just done for technicals and fundamentals on most of the pairs that I'm interested in. What I am going to bring to you now is a little bit of commitment of traders analysis. For those of you that don't understand or don't know what the commitment of traders analysis is, this is our closest thing to insider trading. This is where we can see how there's three types of traders. You've got commercials, non-commercials, and non-reportables. The two types of traders that we're interested in are the commercials and non-commercials. Your non-commercials are investment firms, whether it's hedge funds, private equity funds, anyone that is using the market to speculate from. And a commercial is It's someone that purely uses the market to facilitate business. That means that they actually don't use the market to profit. Okay? They just use the market to facilitate business. So if euros get cheaper, they buy more of them. Why? Because that means that their labor forces or their insurance or to buy an acquisition or a merger within Europe becomes cheaper. Okay? So both sets of traders have different uses for the market. As something gets cheaper, it becomes better for the commercials. As something sells off, it's better for the non-commercials because they'll keep selling it because they trade the trend. Okay, so what we look at is we look to see an imbalance. We look to see where one side of the market, or both sides I should say, become at extremes, and this is where we can predict where the end of trends potentially come in. So we're looking at New Zealand dollar. We're looking at New Zealand dollar on a 36-month look back, okay? And you'll see these vertical yellow lines. These vertical yellow lines are just highlighting where we've seen a huge increase or percentage change, I should say, not huge increase, percentage change in the number of long contracts from the commercials this week to last week. And then what I've done is I've highlighted it with a red horizontal. So you can see each time that the commercials increase their long contracts by over 100%, the kind of reaction that happened. Now the point is, it sounds like they've increased their long contracts by a lot, by them increasing by over 100%, but what kind of reaction should we expect to see from that? Well, we can see that the last two times we had an increase in long contracts by over 100%, we could see that there was a bit of a reaction from the Kiwi dollar in gaining in strength. But since then, the markets have changed fundamentally. Going back to 2013 and through here, New Zealand were actually increasing their interest rates. Right now, they're talking about decreasing them, and the US dollar is actually increasing theirs and not decreasing theirs. So fundamentally, there's been a transition. Now, the next slide is the New Zealand dollar again, but this one is actually going to show you the commercials positioning in the market. The green line down at the bottom down here shows you their number of long contracts, and the blue line shows you their net position, and the red line shows you their short contracts. So when you subtract the number of long contracts by the number of short contracts, you end up with a net position, which is this blue line. Now the yellow line is what I've highlighted as where the current number of long contracts are. And this is after we've had a 100% increase in long contracts from last week to this week. Now if we go back just a few months and we see where the commercials were here, and they actually carried on buying significantly. They've probably had over double the amount of long contracts in the market at this particular time to what they do now. And if we look at what happened in the market at this point, the market had a huge sell-off and the commercials kept buying. So I actually think there's quite a bit more downside to this market, okay? Because the commercials aren't aggressively buying here as they were here, and yet the market has still significantly fell off. What we're looking for is this green line here, the commercial index, to be up and around the 100 mark before we'll start looking for an end of this trend. Okay, so New Zealand dollar, I think there's a lot further downside to New Zealand dollar. So basically, I'm going to keep selling this particular trend. The next one we're looking at is the Japanese yen. Okay, now remember, this is futures markets we're looking at. So when we talk about strength, that means buying yen, and when we talk about weakness, that means selling yen. Now here what we can see is the commercials are at zero. This means they're extreme short. Okay, the net position is right down here. It's as low as it's been. Okay, and you can see their short contracts, the red line, has increased significantly, and the long contracts has pretty much stayed the same. Now, why are they doing this? This is something that we need to ask ourselves. So the commercials have increased their short contracts. So they're looking at selling this market aggressively. Now, are they selling this market based on certain other positions that they might have? Do I think it's got further weakness in it yet? Well, what we need to actually establish is what's going to happen with global markets. So I think we need to see, before I sell yen and sell yen aggressively, I think I'm going to need to see a test of 116 again and see if we get a sell-off in the equities. If we get a sell-off in the equities, then what will happen is I think we'll see a reduction in the short contracts from the commercials. Because right now what we've got is we've got the Japanese yen strengthening. Okay, we've got it strengthening quite a lot, and the commercials will always do the opposite to the market. So I want to see a technically sound reason and fundamentally sound reason to be looking for end of trend. So my bias still lies with strengthening yen, as I believe it's a risk off market right now until I see further notice. Okay, now we're looking at the British pound. Okay, so this will go in line with what I was saying earlier about the GBP USD chart. So here were 2013 lows that we highlighted on our chart previously, and you'll see back here, this is where the commercials were at an extreme, and then we had a year, 16 months long of trend. Okay, so it went from March to July 14 before we saw the big sell-off. So this is the kind of position what I'm looking for the commercials to be at. You can see here, this is the number of long contracts they had in the market. We're not quite there yet. Okay, I think we're going to need to see another further increase in long contracts, which means we're going to need to see a further downward leg in GBP. The market needs to move down in order for the commercials to start buying more long contracts. So 135 is a realistic target, maybe 134 is 136. So I'm looking for the market to come back up into 2015 lows or structure, and then I'm looking for it to sell off. I'm looking for the commercials to increase their positioning somewhere to where they were back here, March 2013, when I will then look to build a position for a long-term hold. So you need to have different styles of trading, understanding where the trend is about to start, i.e. here, and look, the commercials were right both times. Okay, they were right both times. Look what happened. Wouldn't you have liked to have been in here? Wouldn't you have liked to have been in here? Well, it can be done. Use this information correctly, use it with good guidance, get taught properly, understand risk management, trade entries, and fundamental views, and you'll be a very efficient trader. Okay, and guys, that's it for our analysis today. I hope everyone has enjoyed the video. Any questions, please remember to drop me an email at info@phoenixblue.co.uk or follow our Instagram post, direct message on there at Phoenix Blue Trading. And then we also have our Facebook page, which is Phoenix Blue Trading. And then we've got our YouTube channel, which hopefully you'll be seeing this on. Okay, guys, have a great weekend. Be prepared and get ready for the open Sunday night. Bye-bye.